Venture capital is the topic this week, and looking at it not in the context where people usually think about it, which is Silicon Valley, the famous one, but applying it to the continent of Africa, obviously with a bit of a Nigeria bias, because Favor and I like to give all our shows a little bit of a Nigeria positive bias where we can. What does venture capital mean, though, when we start applying it to places like Yabakun Valley, or what are the other names for Yabakun Valley, the Lagos tech hub, Favor?
I think another one was Silicon Lagoon or something like that. So yeah, it's really exciting coming from the African angle because yes, when I hear venture capital, my first thought is tech. But we realized through this episode that it can be more than that, and it is more than that, especially in Africa.
Yeah, so who have we got this week to help us on our journey of understanding venture capital and how that plays through into the broader roles of African economies?
It was absolutely amazing talking to Nneka Eze. She's a managing partner at VestedWorld. And I think my favorite thing about their company is the fact that they are very intentional in the kind of people that they invest in, the kind of companies. And I'm not going to give too much away. I will let Nneka speak for herself during this episode.
I look forward to hearing what she has to say.
So if you could go ahead and introduce yourself to our audience and tell us a little bit about VestedWorld.
My name is Nneka Eze. I'm a managing partner at VestedWorld. We invest in early stage companies in East and West Africa, and we invest in companies focused on essential products and services, technically in sectors that are overlooked by traditional VCs. And happy to talk more about that during this conversation.
Thanks, Nneka. Really excited to have you here. And it's no doubt that venture capital is usually seen as a catalyst for private sector growth. If we're thinking in terms of Africa, where does venture capital come in? And especially as it has to do with our economic growth and diversification, that's beyond areas such as tech. So where do you think that venture capital can come in?
It has a role to play, but it's probably a much smaller role than most other types of capital. In a way, it's a very small piece of the broader financial ecosystem, whether you're looking at public equities, private equity, or otherwise. Venture capital is a very small segment within the private equity asset class. And so I think what it's really set up to do is to push innovation, to take some risk, especially in early stage companies, and help those companies navigate the growth path and their path into the different types of financial instruments as they get larger and larger. So I think venture capital definitely has a role to play. I think, though, it probably has more large of a voice for now because we're still in the early days of the venture capital ecosystem on the continent. We're probably 10, 11 years into the venture capital journey in terms of traditional capital and venture finance. And so we're still in that early stage. People say it takes 20 to 30 years in a venture capital career to really show that you can exit companies and show returns and show the scale. So we're just in that first decade, really, of venture capital in Africa.
Thanks, Nneka. So building on that then, if it's still in its relative early years, if Silicon Valley is the gold standard in terms of venture capital and that kind of ecosystem, where would you say the venture capital ecosystem in Africa is right now? If it's in its infancy still, what are its strengths? What are the gaps? Where does it need to grow into? Give us a bit more about that.
Yeah. I just came back from this debate that we had in Oxford. And one of the questions was essentially, is the Silicon Valley model right for Africa? Yay or nay, or ayes, the ayes and the nays. My view is that we are different in part because of the size of the continent, the entrepreneurial activity that's here, but also the great demand for products and services across a range of areas. And I think the Silicon Valley model doesn't work necessarily. And so we have to have a slightly different take on that model. So that's my general thought. And right now, Africa is about 1% of total global VC. From a population or even potentially GDP perspective, we should be closer to 4 to 6% of total VC capital. And I think part of that is because it's still early days. And I think it's also because of some of the challenges with storytelling around Africa. There's always questions that you get around, what about fraud risks? What about the instability risk? What about the currency risk? All the risks that we sort of look at, you get questions about, and I think that can hinder the amount of capital coming into the sector. I'd say the biggest challenges are around the exits. So you have to return investor capital as a fund manager. And so if you have a limited public equities market, so companies are not going from private capital growing and then doing an initial public offering where they sell shares of the company to the broader public and investors, that means it's really hard compared to maybe in the US. But we are starting to see other types of activities. So whether you have private equity firms coming in to buy into venture capital companies, helping to exit earlier stage investors, and secondary transactions to other venture capital firms as well. And I think people are starting to experiment with other instruments that are more self-liquidating. So some debt instruments, for example, that help to bring some cash back to investors and show that there's those exit routes. So I think that's probably one of the biggest challenges, is saying, like, what is that true path to exit? Is it going to be an acquisition? IPO, probably less likely. Who are the PE players who are actually interested in the companies? I think that ends up meaning that you need to build more sort of resilient businesses that are looking at path to profitability and being EBITDA positive, rather than burning cash in the way that you might be able to get away with if you're able to raise a lot of capital, as you've seen in other markets. I'd say in general, VC ecosystem is probably moving in that direction, given what happened in 2021, sort of 2022 post-COVID era. And even in the US market, companies are more attractive if they're able to prove out that they can earn revenue and also that they can be more sustainable. The pros for Africa, I think, is just the massive potential. So the demographic dividends, obviously, with the youth population, the youth contribution to workforce coming over the next 20 years, and potential, if we're able to answer some of the employment challenges, the buying power that we're going to have on the continent, I think, is really massive. So being able to tap into that has a huge potential market opportunity, which I think everyone is excited about. And I think the other one is just the level of entrepreneurship around, like, new ideas that are coming through. So business models to really address challenges in Africa. And what we've been seeing is a lot of imported models, but then you're starting to see homegrown business models. So everything from, saying, how can we ethically support people with their credit scoring, or how can we actually deal with the major issues of traffic in Lagos and transport tens of thousands of people, from point A to point B and from point B back to point A at the end of the workday. So we're seeing solutions that we think are very tailor-made for Africa's challenges, for Nigeria's challenges. And I think that's very exciting. And it comes from, I don't know if it's like a base level of entrepreneurial genes that we have here, but it's really impressive to see the possibilities as we look at companies.
Thank you, Nneka. So you mentioned earlier about the fact that Africa is only 1%, and definitely at the point of GDP, and looking at other factors, should be at least 4 or 6%. And so my question now is thinking about international donors or development finance institutions. Do they have any role to play within the VC ecosystem? And do you think they are playing their role significantly enough, or is there more for them to do?
That is a very tricky question, I would say. The development finance institutions have had, I'd say, a very large role in the broader private equity asset class in Africa. So if you look at most of the private equity firms, most of their capital, I'd say, is coming from ex-South Africa private equity firms. A lot of their capital is coming from the development finance institutions. I'd say in South Africa, investing that actually goes into the private equity asset class. So it's a slightly different makeup. But it ends up meaning that DFIs are a significant part of the capital that's coming into the continent through private equity more broadly. And then in venture capital, there's been a varied sort of playbook. So some of the DFIs have more of a direct investing strategy where they invest directly into companies. And so if we consider that as VC, because oftentimes they're co-investing along with early stage investors, there's a lot of capital coming into companies in that early stage. And then over the last maybe 5-ish years, we've seen a lot more DFI capital coming into venture capital funds as well. And I'd say part of that is as fund sizes have grown. So there's probably, I think, 4 funds that are over 100 million assets under management in the venture capital sort of asset, those all have DFIs as, I'd say, probably the majority of the capital that they've raised. So yeah, I guess there's a role. Should they be doing more? It's a tough question. Internal politics and strategies, so it's hard to say they should be doing more. Probably hope that other financial institutions in Africa are able to also come in and support this area. So whether that's some of the development banks and institutions or pension funds or others, but I think there are asset allocators globally that should be looking at Africa and need to understand the huge potential for this demographic dividend, but also the risks that could come if we don't make these investments now. So I think everyone needs to be looking at Africa and investing more, and it's hard to just single out the DFIs.
Can I push you a little bit more on that question then? Because you raised some interesting aspects of that. If, say, pension funds or other bits of the financial sector which expect returns to be in line with risk to come through, do you see the Africa venture capital ecosystem of being able to provide the type of returns that they would expect given the risk that's there? Is it something that's compatible, or will it still need to rely on some degree of either donor intervention or social responsibility or of a lessened return with the risk that's involved?
I mean, I would say in general, just given the strategies that I've seen, you're not trying to get a lower return in Africa. You're really trying to compete with, all the global standards around top quartile fund performance and all of that kind of stuff. So I think it's partly the early stage nature of the sector suggests that we don't yet know fully the story of African VC and how the returns are going to look and all of that. So I think there's probably some role in some cases. But that's not to say that a lot of these organizations haven't backed individual companies and also been burned. And similarly, they've backed PE funds that have closed. And so I think it can't be that risk taking is because there's a smaller fund size. But oftentimes that's sort of how it's translated. Emerging managers oftentimes actually outperform more established managers because they're, one, it's a smaller fund size. Two, they're probably hungrier in some ways. And so you're just, actively out there. And so I think it's also about the structures that exist for these organizations to get comfortable with that type of risk. So some of them might want to think of a slightly lower return profile by investing in like a fund of fund structure rather than investing directly into an individual fund. So it's almost like you're doing these individual investments and you could invest in a fund because that de-risks your allocation strategy. You can actually invest rather than in one company, you can invest in 20 companies or 100 companies just by investing in that fund. So that already manages your risk. And then if you're a much larger organization, you might say, okay, I want to invest in a fund of funds because then I get exposure to, 10 funds or 50 funds or whatever the number of funds is in the fund of funds. And that can also help de-risk. I think a lot of it depends on the risk appetite rather than necessarily needing to have like softer capital to encourage people to move into the asset class.
Great. What do you see as the main challenges then that VC face when investing in companies in Africa? And from those challenges, are there any structural issues that you see need fixing?
Yeah, one area, it's fundraising is always challenging. And I'd say it's both for the fund managers as well as for the startup companies. So making sure that, as a fund, you have enough capital to execute on your strategy, I think is sort of for us like the starting point in a lot of ways. And then as a company, are you able to raise the capital that you think you're going to need to raise in order to execute on your strategy as well? I think is another big one, especially where we're seeing a decrease in some of the early stage funding. We're seeing closure of a number of accelerators. I think there's just going to consistently be that question of, are there going to be enough deals that we're excited about investing in, and then are those companies able to either scale with the capital that they've raised or be able to attract additional capital in order to get to those next growth horizons. So I think that fundraising sort of capital piece continues to be a challenge. And I think systems and people is probably the other challenges. And I think this is for all startups probably globally, but just really putting in place the systems to build a high growth company I think can be really tough because you're growing so fast for a lot of the companies that may not have all of the systems that you maybe need to have in place around just, building out a CRM or making sure that you have multiple levels of control on your finances. I think that's can be okay in the very early stages, but I think as companies mature to that Series A, making sure that they put those in place even as they're growing very quickly, and having investors or other advisors who help companies get there, I think is really important. And then on the people side, we have seen a lot of movement of talent, particularly to Canada, I'd say, across different portfolio companies. And that is challenging. So if you hire senior person on the executive team and then they get an offer to go elsewhere, it can be really tough for a company that's high growth, but maybe is not paying the highest salaries. We've also seen quite a lot of people going into different industries or related and adjacent industries, but that movement of people to other markets has been a challenge. Companies, especially the larger companies who've raised significant funds, are able to maybe keep that person on as a contractor or even hire consultants outside of the market, but that means that they're paying in foreign currency, and there's usually a pretty high expense for that.
So as of July 2025, Nigeria's interest rate stood at 27.5%. So if we're looking at that and we're also looking at the attractive government bonds that we have, would you say that venture capital is sustainable, is in a sustainable environment in Nigeria? Does Nigeria present a sustainable environment for venture capitalism? And Richard talked earlier about risk. So I as an investor, why would I want to take such risk when I look at the interest rate and there are so many other attractive
Yeah,
government
definitely. I
bonds?
mean, I'd say the VC ecosystem that is Nigeria focused is very small and undeveloped in a lot of ways. So in terms of the number of VC funds that sort of have Nigeria as a focus country, there's only a handful. And then there's a number of Pan-African funds that invest also in Nigeria. But Nigeria is still getting like such a large percent of the deals, the unicorns, all of that. So I think there's excitement around the broader idea of Nigeria, but when it comes to it, I think it is very challenging to compete for Naira denominated investment if you're looking in VC in Nigeria, is the structure of the economy at least. That being said, I'd say there's only a handful of strategies that have Naira based on strategy. They're actually raising capital in Naira and deploying in Naira in Nigeria. I say the majority of the VC funds that are investing across Africa are dollar denominated. And so then you add the significant currency risk challenges to everything. It makes it very tough. So you have to essentially invest in companies that are growing faster than inflation and outpacing devaluation at the same time. And that means you're really looking for high growth companies, even if they're in some of the more traditional sectors, like I mentioned, mobility, and one of the companies is Shutlers. And, we're very excited about their growth. They've grown 5 times in terms of the number of routes since we invested over 3 years ago or so. And I think you have to identify companies like this that can really outpace some of those, especially if you're looking at returning dollar denominated capital. And that's going to continue to be a challenge until there can be I'd say more local industry development, lower inflation, and let's see what happens with the interest rates alongside that. But yeah, I think for us, it also makes it like Nigeria has to be a compelling market because of all of the demographics and the scale and the size and all of that. But we also invest in other markets. And part of that is to reduce some of the country specific risks that we know exist here. And I'll tell just like a quick story, but I think it was sometime last year. I was doing a deal in East Africa and Kenya, and I was asking my colleagues, I noticed that we didn't really factor for inflation very much. I was like, low level of inflation. And when I lived in Kenya over 11 years ago, inflation was definitely higher than it is now. Now it's like less than 5%. Sometimes it goes up to about 5%. And I think last year it was somewhere like 5.5%. And things are getting more expensive in Kenya, but not at the same rate as they are in Nigeria when you look at like Kenyan shillings or Naira. it means we have to take that into account as we're investing in companies. But looking at a country with like a 4.5% inflation rate compared to 21% or so, sometimes 35, 40% inflation, it makes, yeah, it's not easy. And then maybe just to like circle back to your original question, I'd say VC as an asset class has generally been the remit of high net worth individuals and institutions. And I think part of it is because it is a highly risky asset class. And so if an individual was looking to enter, even as a high net worth individual, would have to be as part of like a balanced portfolio they were investing in. So it would not be that you're investing everything you have into VC, although many people do that, like fund managers. But I think it would be more about like, what is the role of VC in a balanced portfolio? And all of that is about how do you manage the risk that you're comfortable with taking.
Can I build a little bit on the Kenya example that you gave? If suppose Nigeria had inflation that was at Kenya's level rather than the inflation it suffered from over the past few years, whether if it had a much lower risk of devaluation, a more stable currency, interest rates were say 10% rather than what they've been in more recent years. What kind of companies would it be viable for you to invest in Nigeria then, which are not currently viable for you to invest in right now? Or would it not change the type of companies you're approaching because you're always looking for the unicorn, and therefore it really doesn't matter so much because you're hunting for unicorns?
Yeah, we are probably anti-unicorn. I don't know if we want to call that anti-unicorn portfolio. No, I'm excited that unicorns exist. Compared to India, which is obviously it's one market, so it's slightly different. But in comparison, India has 10 times more unicorns and 3 times more capital than all of Africa. And so they are further along in terms of that like development of unicorns. But the thing I find most interesting about the Indian unicorns is that tech is maybe the second or third sector in terms of representation. And so you actually have unicorns that are agri-tech. And honestly, those are mostly real ag businesses, not production necessarily, but sometimes touching production that have gone to really significant scale using technology as like an enablement layer. There are also a number of consumer CPG companies that have been able to get to that unicorn status. And I think we're still very early on that journey in Nigeria and in Africa, where most of these unicorns are in fintech. So our view and what we are modeling for is actually looking at companies that are in essential products and services, focused on Africa, focused on Africans, that can have that scalability, but do not necessarily need to have the $1 billion sort of valuation in order to get returns for our investors. So I think we would continue our strategy. I think it might. Yeah, I don't think it would change much. I mean, we have probably about 40% of our funds invested in Nigeria. So I don't know that we would necessarily want to do more because we have a multi-country strategy. We like the idea of diversifying across the different markets. I think it would probably help our companies to scale faster. I think it would be easier to diligence companies and try to understand okay, much of this was devaluation, how much of this was actually your customers saying they're no longer interested in product, or how quickly do you actually need to scale? And you grow fast, but not at a breakneck speed. So I think it would probably more impact the companies necessarily than our selection of those companies. If debt capital was more reasonably priced, I think it would really help the scale of companies because we're providing primarily equity, and many of our portfolio companies, especially in these overlooked sectors like in mobility or in ag or in consumer, are going to need debt to finance their operations in some way, whether it's working capital or it's capex to sort of scale and expand. Right now, as you guys know, that is very challenging to do at a 27% interest plus. And so you end up either needing to get some subsidies or donor-funded instruments or whatever the thing might be, or even dollar-denominated instruments, which make it very hard in terms of the currency risk. And so I think our companies would probably scale even faster because of availability of this type of debt financing instruments, or that's the hope at least.
Thanks. Let's move things on to regulation now. And it would be interesting, given the different countries you work in, what you see as the main regulatory challenges that you face, being a VC operating across different African countries. And if there were one regulatory policy that you would magically be able to change, which would make a world of difference for being able to scale up your investment, what would that be?
Yeah, no, we have this matrix we developed called the Fierce Risk Matrix. So we look at fraud, instability, expropriation, regulatory currency, and then enforcement of contracts. And the regulatory piece, I feel like, is changing every week almost. The fund manager, I think the most recent policies around fund management regulations are the most challenging. So it feels like there are a number of countries that are becoming slightly more interested in these unicorn exit stories and other exit stories. And so are either after the fact, many years after the fact, starting to tax transactions like years after they've closed, or are starting to interpret policies that have existed for a long time in very different ways around like a typical fund structure. So I think that is going to make the burden even heavier as we think about exit pathways to say, okay, if previously the tax rate was at this level for capital gains and now it's going to be 10% or 20%, that does change your exit sort of math. So I think that's one thing. And then I think the other one is just in terms of where you decide to actually domicile your fund and where you decide to have your team be present, I think is the other one. So I wouldn't get rid of the policies, but I would probably hope for additional dialogue between the regulators and the fund managers, whether that's through our associations like PEVCA in Nigeria or EAVCA in Kenya, to really help think through what makes sense and what's going to keep attracting our capital into those markets.
So I know this is something that VestedWorld is really passionate about, but how can VCs foster a culture of innovation and entrepreneurship in Africa? And are there particular success stories from VestedWorld's portfolio that illustrate this?
I think it's in backing the founders that we think are going to change the way that Africans live, work, and play. And that's one of the things that we are excited about doing, like at VestedWorld. I mentioned Shutlers earlier, but I think that is one example exactly of that. Dami, who's the founder, Damilula, founder of Shutlers, decided one day that she didn't want to ride in the buses in this way, that it was very tough ride to work, that it's seemingly unsafe in a lot of ways, joining a stranger on a bus who's taking you to work and maybe back from work. But there's a lot of questions that can come from that interaction, both around theft, abuse, and just level of comfort. She started Shutlers to really transform the face of mobility in Nigeria, in Africa, potentially even in the world. And what we've seen over the last few years since investing is just like that massive growth rate that I've talked about. Also seeing them expand to other markets, which we're also really excited to see. The other thing is that they're changing the way people actually move to their work. So we're working with people who used to be driving. So 40% of their customers used to actually drive themselves to work. Now they've decided instead to take a bus. And I think that's a massive culture shift, behavior shift. It's something that we're starting to see where people realize that they want some level of comfort and they can do it at a price that's competitive with the alternative offering, which is not as comfortable. So I think that's one that really stands out in the portfolio in terms of really changing behavior. Another one that stands out is Drugstock. They are working with pharmacies, PPMVs, clinics across Nigeria, providing essentially pharmaceutical products to those companies. I think what's interesting about them is that they've built really from the ground up. So you have to build a distribution platform that can actually service these orders across the country. You have to layer on financial services to the pharmacies so that they can, deal with the working capital finance gap that we talked about. So you're actually helping to provide financing, and you're helping to balance out your product mix. So you have very low margin products as well as products that perhaps are helping as well with some of the margin. And I think they've done well to expand the range of services given the platform that they've developed in Nigeria. We have so many examples of this, but Tomato Jaws, the tomato paste processing company in Kaduna, is another example where prior to their coming in, there really were not tomato paste processors that were locally processing tomatoes in Nigeria. There were some attempts for the years. They, I'd say, are the main one, noting some of the challenges other manufacturers have had in that space. And so I think some of it is going to be about backing founders who have these ideas that are going to scale and grow. And I think I mentioned Be Free as well, one of the ethical credit collection companies that's really helping people to manage through this, all the finance and micro lending that's happening and the aggressive behavioral tactics of some of the collectors. They're coming in to really change the way that debt collection is being done, working directly with customers on a one-on-one basis to really help improve their credit scores, improve financial knowledge, but also to get the funds back so that they are able to be borrowers in the future if they need to be. But we have a host of portfolio companies that I think are in that vein of really bringing innovation to the continent and to important issues and challenges.
Thank you. Let's talk a bit about diversity and inclusion. If I go back to 2018 when I was working in Nigeria, and I think about a workshop that myself and a couple of colleagues from the High Commission attended down in Lagos. It was with the financial sector. I forget what issue within the financial sector the meeting was on, but there were two women in that room, and both of them were from the British High Commission. There's obviously a big challenge in terms of how women are represented in the financial sector within Nigeria, but I guess also probably that extends to some degree into the business community as well. VestedWorld, I understand, have quite an intentional approach to the kind of founders that you back. Firstly, how do you find it heading up a venture capital firm, being based in Nigeria as a woman, but then also what's VestedWorld's approach and how intentional are you about finding women founders, finding people from diverse backgrounds, maybe people with disabilities, people from communities that don't traditionally get that sort of venture capital finance? How do you go about that?
I think a large part of it probably starts with the team. So I'd say my business partner, Euler, and I are deeply committed on these issues in terms of backing both female founders, but also backing African founders. I think we've seen there is no reason for there to be this sort of gap in access to finance for those categories of people, except that the people who fund are not providing finance to those areas. So we don't see major differences in terms of the potential for female founders and African founders to really transform the face of the continent. And so I'd say it's just from like a little bit our personal interest in saying this is an area that we need to focus on and that everyone should be focusing on. There's also a clear case from a return perspective that investing in diverse founding teams that have diverse management teams and diverse boards have a much higher chance of having a higher return. And so I'd say that's part of why we've been trying as hard as we can to align with the 2X challenge. So over 90% of our portfolio companies are sort of meeting those 2X criteria around diversity. And we have about 40% of our funds currently are invested in companies that have at least one female founder. I'd say about 20% have a solo female founder, a female-only founded team. And it's an area that we're continuing to really focus on throughout. So we do have, a gender lens strategy for the fund, and we also report on these areas because we think it's really important. And it's not just like in an annual report, and we actually haven't done anything publicly, but on a monthly basis, we actually check in on our sort of metrics and understand like how we are doing as a fund as we think about capital allocation. And then on an annual basis, we check in with our portfolio companies on how they're performing across a range of metrics. But yeah, I think it's about being intentional from top. And then what's that meant is our team is also fairly diverse. So we're, I'd say, pretty, it's a small team. So we try to be pretty balanced in terms of backgrounds, in terms of, educational backgrounds, and then, of course, in terms of gender as well. So I'd say right now we're probably slightly skewed more female investors than male, but it's about 50-50, sometimes 60-40 because of the size of our team, but it's something we've to be intentional about. I think it's actually one of the issues and what I see is maybe broken in venture capital. If we think about importing the Silicon Valley model, similar issues exist in the US where, 20% of funding is going to female founded companies. If you're a Black woman, you're getting a very small percent of that. I think it's like less than 2% of venture capital, maybe even less than 1% of venture capital is going to Black women founded companies. And I'd say we're having similar metrics in Africa. About 20% of VC funds are going to female founded companies. And, if it's female only founded companies, it's 5% or less. If there's a female CEO, I think it's somewhere between 5 to 10% of funds are going to companies led by female CEOs. Unfortunately, if female founded companies, female led companies don't get early stage capital, they're not going to be female founded unicorns. You have to sort of find the companies early and back them over time. And so I think it's really important for everyone to get on board, but I think it's going to take, decades before we're able to really convince people that this is the case. And hopefully we'll have made our case and made our returns before then, and people will be able to follow suit.
Spoke earlier about the fact that Africa is still in the early stages in terms of the VC ecosystem. But where do you see it evolving in the next 5 to 10 years, and what needs to happen to ensure? I know we've already spoken about some factors, but what needs to happen to ensure that it reaches its full potential?
Yeah. I think, we had this discussion. I mentioned this program I did a couple of weeks ago, and it was one of the debates and discussion points is like, will VC in Africa double over the next 10 years? Like, will it 10x over the next 10 years? Will it, we've been on this journey of a bit up and down sort of post-COVID period of time. But I think everyone in the room was mostly positive about the potential for venture capital as an asset class to really grow significantly over the next decade. Perhaps it will get to 10 times its size. So maybe that would be anywhere from 3 to 4 billion right now, depending on the year. So let's say $30 billion coming into Africa, going into the asset class. I think that would be amazing to see that kind of growth. I think what it needs is institutional quality fund managers continuing to identify amazing companies. And I think we need founders continuing to be dedicated and invested in Africa and willing to do that incredibly hard work of building businesses and do it at a pace that VC requires. So I think all of those pieces need to come together, and we need investors who are interested in that growth journey.
Thank you. Final question then. What advice would you give to entrepreneurs who are looking to attract VC funding? And what advice would you give to maybe new VCs who are thinking of coming into Africa or thinking about setting up here within Africa? What would be your key advice to those two groups?
For entrepreneurs, I think it would be to, as always, like, your business well, who you need or maybe want on your journey. Be intentional as you can be about finding partners for your journey when you're looking for investors. I think that's probably the number one piece of advice, if I can give advice to founders. Then for anyone thinking about VC, it's a really tough industry to get into for some reason, because we're still so small. So if you look at most funds, there's maybe 5 to max 20 people, even at some of the much larger funds. If you start looking at funds that have a PE strategy, maybe they start to have more people, but number of seats, if you will, to enter into this space is really, really small. And so finding the way in, I think, is about relationships. So it's about staying in touch with people that you want to work with over time, because let's say for us, let's say we launch a fund at some point, then maybe we can actually increase our team size. But in between funds, you're not usually increasing your team size because you have a fixed budget based on your assets under management. And so just really understanding some of the challenges with entry, it ends up meaning that you need to build those relationships over time. And it's similar to how we invest. We like to know founders for 2 years before we invest on average. And so with a team member, we generally either know them or maybe know somebody who knows them very well for a period of time, because you're only hiring, 1, maybe 2 people in any couple year period. So I'd say keep it up and look at the programs. There are a number of programs now focused on Africa to build that next cohort of VCs. And I'm always happy to talk to people who are interested in this journey.
Thank you so much, Nneka. Thanks for taking the time to speak with us at Flywheel Economics.
Thanks for having me. Thank you both.
So, Favor, now we've had a chance to hear a little bit about venture capital in Africa. What were your big takeaways?
Yes, just as I said in the beginning, very interesting conversation with Nneka. And I think venture capital is really exciting because of the fact that it presents this alternative model to traditional finance when we're talking about access to capital for businesses. And it is especially crucial here in Nigeria and across Africa as well, because we know that businesses often find it difficult to access capital in terms of taking loans from banks. Those are usually more difficult. But at the same time, I feel our conversation with Nneka really called us to maybe temper our excitement a bit. That while venture capital has this potential and it is doing a lot of good, it's still in its early stages. And because it's still in its early stages, we can't put all our weight on it. All the other players still have to be there. As we have often said, we still need to get that microeconomic going and going well. So venture capital, very exciting, and I hope our listeners took that away from our conversation with Nneka. But for me, it was just, we can be cautiously optimistic. We are still in the early stage, and we're still seeing how it goes, basically. And I think another takeaway for me was just on the aspect of storytelling, because that's a huge part of what we do here at Flywheel Economics. And Nneka was talking about that Africa needs to find a way to tell better stories of itself. When we think venture capital, when we think investment in Africa, the first thing that comes to people's mind is the risk of doing business, or maybe currency risk or regulatory risk. But it's more than that. That's not the whole story. We've quoted Chimamanda several times, but the danger of a one-sided narrative. We can also think of the fact that we have the demographic dividend. It's been said that by 2050, more than half of the world's young population will be stationed in Africa. That's something good. That's something huge. And if we can invest, if we can unlock it right now, we are looking at the benefits over time. But we also have things like innovation. Richard, you yourself, you have said it so many times. You were here in Nigeria for a long time, and you see how innovative Nigerians can be just as a response to things that are not working. So yes, there's that story. So when we think of Africa, when we think of investing in Africa, it's important that we don't think just the risk. We have to look about the other aspects. And I think just to add to Nneka's points, because she was one that mentioned demographic dividend and innovation, I would say we're also hungry, and not in the type that is usually depicted in the media. We're hungry to do more. We are hungry for innovation. And so that's why it's important that investing in Africa should be taken seriously. The biggest takeaway that I hope our listeners took from this episode when listening is the fact that, why do we tell stories like this? Why is this episode important? It's not just about money. It's not just about, let's make the big bucks. It's about the fact that financial solutions just like this have the avenue of unlocking long-term economic growth and development that will have good results in the lives of real people. We're talking of prosperity, we're talking of wellness for real people. And that's why I felt like this episode is important, because we're saying, how can we unlock businesses? How can we ensure that African businesses thrive? And when they thrive, what is the aim? Just so we can celebrate and say we are rich? No, that's not just it. It's so that people, young Africans in general, can have a better standard of living. So those were just some of my big takeaways. Really interesting conversation. How about you, Richard? What were some of the things you took from this episode?
Well, I'm reminded to some degree of the two voices I get in my head, right, when it comes to tech and business startups in Africa. And on the one hand, I'm going, these challenges that you face in Nigeria, whether it's bad electricity, whether it's poor roads, whether it's poor access to capital. There's a business opportunity in every single one of them, right? And we should be really optimistic that we just need to back these young people with their businesses, with their workarounds and their solutions around it, and everything will be fine. And the Nigerian spirit will overcome the deep-rooted problems that we face. And I remember giving the kind of pep talk along those lines to a large group of young Nigerian entrepreneurs, and they all had kind of glum faces as I was telling them, like listing all the problems problems, saying it's all a business opportunity, it's all a great way for a tech innovation or a workaround. So, and I get that. Whilst we can put a positive spin on things, there's the other voice on my shoulder which says you can't entrepreneur your way around poor governance, and there's a limit to what you can do, right? And so, that more pessimistic outlook is when you start looking at 40% interest rates, or you look at some of the difficulties that companies have when taking their money out of the country and things. Like we often say on the podcast, two things can be true at the same time. It's possible for opportunities to exist in a environment that can be quite stifling overall to business growth and potential. But I think what we see with venture capital is, and what Nneka and VestedWorld showed very clearly, is being able to take a bit of a risk on companies, on individuals, on teams, in order to try and get a high return. And in doing that, in getting that high return, they have to be doing something which is adding value or solving some sort of challenge within the Nigerian economy. And if we look back at some of the success stories over the years, a lot of them come from fintech space. I don't think we went into a lot of detail on some of the past sort of unicorns out there, but Flutterwave, they were very high profile payment platform that did very well. I think they were one of the first, or one of the original unicorns from Nigeria. Very, very good, very successful. I know a couple of people, or one person at least, who invested in Flutterwave before it went really big and did very well out of that. And I think there's a bit of a quest. When I was in Abuja last week, everywhere in Abuja there were signposts up for OPay, trying to market, trying to advertise, and you can see it's another fintech, right, on its way to the top, if not already there. Becoming part of the mainstream infrastructure which Nigerians use to make payments to each other. So you've got this space where fintech has traditionally owned. But I love the fact that Nneka was looking at other sectors as well, looking at agri-tech, looking at some of these other parts of the economy. I remember from my time in Nigeria, there was some great innovations going on in the agriculture sector from tech companies. Hello Tractor, looking at how you can lease a tractor, just like you would hire an Uber. You could call a tractor to your farm for the period when you needed it. And you didn't have to then have this looking for capital, looking for trying to buy your tractor, which for most of the year is going to be unused, right? You have it for the time you need it, you pay for the time you need, and that's a great solution, right? A great innovation. Lots of other things about cooling facilities for refrigerating your harvests, your crops, keeping things from spoiling. Those kind of technologies out there, whole host of areas that can make a difference in the lives of people in the here and now. So look, there's lots of really interesting things there, but what I really took away from what Nneka said was they don't all have to be unicorns. You can get decent high returns, which is what they're looking for, without having to invest in a unicorn every time. Yes, of course, I'm sure they would not turn down one of their companies becoming the next unicorn, the next Flutterwave, but they don't have to be in order for the model to be successful. And I see this as a really good addition to the financial system within Nigeria, but also more broadly across Africa as well, to have these venture capital firms in place. Any final reflections from you, Favor?
Yeah, I think I just wanted to pick up on your point about the chasing unicorns, and her point on saying not totally, but they were in some ways anti-unicorn, because it's not just about that biggest thing. Sometimes it can be about the most impactful thing, which doesn't, or they are not usually the same. The most impactful thing might not be the biggest thing. So yeah, I enjoyed that point about chasing, finding a different metrics, of say of determining what is important.
Yeah, what we've heard today shows that venture capital isn't just about chasing unicorns or the next big app. At its best, it's about planting seeds in the soil of an economy and helping the whole ecosystem grow. And that's what's at the heart of flywheel economics, right? Economies are living systems. They flourish when energy and ideas circulate and when people and resources connect. And you get that momentum building, right? You get that momentum building naturally. And so venture capital can definitely be one of those flywheels. If you look at the investments, each investment can spark jobs, inspire other people to take risks, create these ripples of innovation across communities. That's the Yabican Valley story, right, Favor? The one that we looked at in one of our first podcast episodes. These communities that take off on the back of it. But it works best when it's aligned with the ecosystem. So, and this is what I really liked about Nneka's approach and VestedWorld's approach. They valued that local teams, that local knowledge, and they embraced diversity. And they were looking beyond the short-term wins, as you rightfully said, Favor. And I think that's when VC becomes more than just finance. It becomes part of that transformation that we're looking for. Flywheel economics, we're looking for those natural flywheels that build. And I think venture capital has this quite unique way of being able to back those flywheels, get things to scale, get momentum going. So maybe the goal isn't to recreate Silicon Valley, but to build something new, something rooted in Nigeria's strength, in Africa's strength, a flywheel of innovation and opportunity that keeps spinning long after the first push. So I think this has been a fantastic episode for us, looking at what flywheel economies look like in practice and how venture capital can help get that wheel really spinning. Any final thoughts from you, Favor, before we wrap up?
Yeah, just to say that we wouldn't be the Flywheel Economics podcast if we passed up an opportunity to draw parallels. And of course, venture capital is that seed in the soil and really exciting. So, yes, no more final reflections from me. Just to appreciate our guest, Nneka Eze, for coming on the show and sharing her thoughts with us. It was an amazing episode. We really enjoyed our conversation. To our dear listeners, don't forget that you can head over to our website at flywheeleconomics.com in case you're interested in the work that we do. And we also love to hear your thoughts. Reach us on social media. Our handle across board is Flywheel Economics. Until next time, this has been the Flywheel Economics Podcast.